The market is way too optimistic about rate cuts. The market is way too optimistic about rate cuts. It makes absolutely no sense for market participants to bet on multiple expansion at the same time as they bet on massive rate cuts. Why? Because the only reason why central banks would cut rates as much as markets expect in 2024 is if there is a massive contraction of the private sector. And we are going to face persistent inflation because all of the elements that we look at are showing that inflation is likely to persist at higher than target levels. Let's look at the first graph of the week. This graph, courtesy of Bloomberg, shows expectations for 2024. They tend to be optimistic, certainly positive. This is a huge reduction in the level of inflation, but this reduction of inflation, let's look at it, is much slower than what we would expect with the decline in monetary aggregates. Monetary aggregates are declining faster, and inflation is not falling as much as they should. In fact, the inflation rate should actually be between 20 to 30% lower considering the decline in monetary aggregates. Therefore, what this means is that fiscal and monetary policy are very different, are completely opposite. Governments are spending like there's no tomorrow in a period of high inflation, so inflation is likely to be persistent. In this scenario of inflation, courtesy of Bloomberg Economics, central banks are unlikely to cut rates because this means that the economy remains overheated and that there will be the so-called soft landing, which is impossible because in reality soft landing doesn't exist. It is a huge contraction of the private sector with governments spending way too much and deficit spending. And let's look at what we are likely to see in the next graph. This next graph is very important for what we are likely to expect in 2024. Central banks continuing to reduce their balance sheet, slower than in 2023, of course, but no quantitative easing. Quantitative easing makes no sense in the scenario that central banks are working with. The G4 central bank balance sheet is showing that contraction is much slower than it should have been, and therefore policy of central banks is fundamentally accommodative. Don't bet on central banks implementing quantitative easing and certainly rate cuts in an economy that remains with low growth and high debt, but not in a massive recession. Even more importantly, even if there is a technical recession, central banks are not going to change policy. They are loss-making. They know that they would create another inflation burst. More importantly, they know that quantitative easing would have absolutely zero impact on the real economy in a technical recession. Let's go to the next graph, which shows us one of the things that market participants need to pay attention to absolutely as critical for 2024, the wall of maturities. 2023 did not see massive bankruptcies or challenges in the corporate and sovereign debt sector because most issuers had prolonged and moved their maturities as much as they could in the period of negative rates. However, this graph, courtesy of the Financial Times, shows that in 2024 and 2025, we have an enormous wall of maturities from the corporate sector, particularly in high yield. This will create ripple effects in the economy, and we need to pay attention to it. But what's most important for market participants is what this next graph is going to show us. In this next graph, what we are going to see is the impact of the refinancing of debt from the United States in liquidity in the economy. Let's look at this following graph, please. Exactly. In this graph that you're looking at, we see the maturities of the United States. The government in the United States is going to refinance $7 trillion of maturities in the next 14 months, 14 to 18 months. What does that mean? It means that added to the $3 trillion of maturities that we just saw from the corporate sector, it is more than $10 trillion of less liquidity in markets. In an environment in which, even with accommodative central banks, they are going to refinance that debt, probably at a higher cost. We don't know, but it's going to be refinanced. What does that mean? Less liquidity for markets, much less impact on multiple expansion. This effect, the wall of maturities, is critical to understand the impact on markets of changes in monetary policy from central bank. Number one, central banks, even if they go and pivot their policy, are not going to inject $7 trillion of liquidity in the system. It is not going to happen. Therefore, there will be a net negative liquidity effect in the system in 2024, even if central banks pivot. Number two, if they cut rates, the impact is likely to be on these issuers, sovereign bond issuers, not on the corporate and the high-yield sectors, for a very simple reason. The liquidity drain starts in 2024. It didn't start in 2023. It started mildly. It was extremely moderate. What we are likely to see in 2024 and 2025 is that even if central banks pivot, the impact is going to be very small in terms of the liquidity drain, that they cannot suddenly go gonzo and implement a $10 trillion quantitative easing program, which makes no sense in a moderate slowdown of the economy. Even if there is a technical recession, even if there is a moderate or even severe contraction of the private sector, because why? Because governments are spending like there's no tomorrow, and no, central banks are not going to save them 100%. Only allow for that liquidity to go to government maturities. Government maturities will happen. They will drain liquidity from markets. That means less multiple expansion. That means less liquidity for stocks, less liquidity for corporate issuers, and a drag in the certainly very exuberant and very optimistic view of market participants about 2024. Liquidity drain starts now. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.